Hi there, it's me, Stephen Thomas with Report on Housing, and I'm coming to you on a Friday, June 20th. And this week, we have another housing debrief. I am back from vacation. I appreciate Brennan Thomas for pinch hitting last week. But invite everybody to like and subscribe to this YouTube channel if you like what you're seeing, you like the content, and you want to see more of it so we can get the YouTube algorithms going so that more people can properly set their expectations for the housing market with real facts and data. I'm a housing, I do housing and analysis for a living. We follow all of the housing analytics. It's been a lot of fun. The journey's been great. I've been doing this since I've been in the real estate industry since 1991 and have a quantitative economics and decision sciences background. So this is my passion, is all the analytics that go into housing. So let's jump right into it. And this week is this the end of the housing boom? That's really what the question is. Is this the end of the housing boom? Now, I want to go backwards in time a little bit. And so we had COVID-19 that was in April of 2020. Everything was shut down completely. And we had mandatory COVID lockdowns. The Fed jumped in when we had that COVID-19 scare with the pandemic. And ultimately, the Fed jumped in, and boy, did they jump in. And you could actually see it by looking at the what happened in the federal funds rate. Now, the federal funds rate is the short-term rate. It's an overnight banking rate. But their whole plan was to bring the federal funds rate down to zero to make it so that it'd be easy money, very easy lending, as well as they did a number of other things, other tricks that were up their sleeves. And as a result of bringing the federal funds rate down to zero, that applied a lot of pressure to 30-year mortgage rates. And you can actually see this. That red line is 30-year mortgage rates, and 30-year mortgage rates made their way down. And I'm pointing to this. This green arrow was 17 record lows, all-time record lows in the 30-year mortgage rate. And it drilled all the way down until we got to January of 2021, where we hit 2.65% across for 30-year mortgage rates. That was an all-time record. So it was very, very low interest rates, extremely low. The interest rates were so low that oftentimes now inflation has exceeded where interest rates are for housing. So it's been an excellent hedge against inflation for all those people that got interest rates that were below 3%. And the Fed was busy printing a lot of money. There was a lot of programs that they did. And that was basically to get us from the start of COVID to when lockdowns were done and all the people that were out of jobs were back into jobs. So this was to build that bridge, but they pumped a lot of money into the economy. And so what did that mean for housing? So if you have really, really low interest rates, as far as housing is concerned, we saw demand soar. At first, when we had the COVID lockdowns, everybody was wondering if, hey, you know what, is anybody going to purchase real estate again? Are we going to be able to go back to normal ever again? It felt ominous when we had those initial COVID lockdowns. But interest rates kept on going lower, where people were just clawing at trying to get after housing, and inventory levels were already extremely low and demand really rose. Inventory kept continuing to drop to lows that we had not really ever seen in modern history. You have to go way back in time when population levels were so much lower, but inventory levels just started to plummet down to levels where there was very little available across the United States. So as a result of, if you have demand going through the roof and you have inventory coming down, the market got so extremely hot that home values rose, and you could see it was almost felt like values were rocketing, and that was those years. It was like almost 2 years solid where there were offers made that were well above the asking price, and we saw values climbing at an overwhelmingly fast pace. And if you look closely as to what the Freddie Mac home price index, and I like to look at home price indices. I don't really like to look at medians because it's really like for like properties and what they sell for. And you can see what happened over time. You can actually see where values were as far as this is an index, so it's pegged on over time to see what values are doing across the United States and in various metros across the United States as well. And you could see there about 2/3 of the way across, you could see the Great Recession when values came down. And from 2012 all the way through 2019 and the start of 2020, values were going up on an annual basis. They would be kind of flat for the second half of the year, and that's why you get that stair step that you see there on the screen. And then ultimately, so what happened when the Fed decided to lower the federal funds rate down to nothing, and what we saw is record low interest rates, those 17 record low interest rates. You could see what happened to home prices. Home prices absolutely skyrocketed upward, and that's what you're seeing right there. That is from 2020, March 2020, all the way until we got to the start of 2022, and you could see how much home prices accelerated higher. So then we began to see an inflation problem. This started to occur in 2021, and by the time we got to the summer of 2021, we could see that it was going to be a real problem, and it continued to be a problem that manifested itself and got larger and larger. And that's where the Fed said that the inflation was transitory, but by the time we got to summer, it wasn't as transitory as what they thought. And then that's where they knew that they had to do something as far as changing that short-term rate, bringing it down from the floor of 0 and starting to increase it. The issue is that they didn't want to rock the system too much because we were still kind of dealing with COVID. But so what they did is they said ultimately by the time they got to December that by the time we get to March, we'll start to increase the federal funds rate. They should have gone almost immediately in hindsight, but they waited all the way till March of 2022 when the problem was really starting to really make itself evident starting in the summer of 2021. So as a result, they really did ratchet up rates, and that's because they should have been ratcheting up rates earlier. They went at a very, very fast clip. Remember, they were at a floor of about 0, what they call 0 to 0.25%, and they went all the way up to 5.5% over time. And you could see this. This is the Fed is moving historically fast to tame inflation. They really did. They moved at a pace that people really had not really seen before. So that's where we saw a real elevation in rates. And you could see it right here. This is that stair step, and it was a very steep increase where they went from a floor of 0 all the way up to 5.5% in the federal funds short-term rate. Now you can see what happened to mortgage rates. Mortgage rates really zoomed higher, and they started off the year at 3.25% and made their way all the way up to over 7% by the time we got to October of 2022. So that was a more than doubling of interest rates. And then ultimately we saw that since October of 2022, that interest rates have been dancing right at 7%. So they've been stuck at 7% elevated when we were used to rates that were a lot lower. 5% was a ceiling that when we got to 5% in the November of 2018, we had an issue where all of a sudden demand stopped and we built a lot of inventory. And so we were used to interest rates in the low 4s to even below 4 in the 3s prior to this rise in interest rates starting in 2022. And now we've been stuck above 7%. And a lot of people reminisce when they had interest rates that were a lot higher. Yeah, but when you had interest rates that were a lot higher, property values were a lot lower. So unaffordability, the affordability indexes right now, if you go backwards, they kind of match where we were during the Great Recession. But if you throw in insurance, it's the highest level since the 1980s. And that's kind of where we've been stuck because we've had interest rates that have been stuck right at that 7% threshold. So home affordability is an absolute issue. And there's a lot of people that thought initially that what's going to happen is, oh my gosh, now that we have these higher interest rates, we are going to see values come down. There's going to be just a big giant housing crash. And we heard it from everybody that that's what was going to happen. Now, initially prices did come down, but we'll talk about what happened there. But first I wanted to bring in our sponsor, and our sponsor this week is Angie Sandoval from JMJ Financial with the Thibodeau Morel Group. And you can reach Angie at 310-418-9722. And Angie has this program at JMJ Financial. It's all in one. And what is it? It is a 30-year HELOC with an integrated sweep checking account. In other words, it combines your home financing and personal banking needs into one dynamic tool. This is a really cool product because this is how it works. If you're like most Americans, you probably earn more income in just 5 to 10 years than you owe on a mortgage. That volume of money far outweighs your housing debt. And so what you do is you put you deposit your money into your account, and it's an all-in-one. And what it does is it sweeps that account. So the monthly interest recomputes nightly based on your loan's unpaid principal balance. Deposited cash left in the HELOC compounds interest savings and accelerates home payoff. So it's just kind of like using this 30-year HELOC as your checking account, and as you put money into your account, it offsets that HELOC, and it's a fantastic program. So you don't pay your bills all in one day. So that money sits in your regular checking account, earning no interest at all. But if you put it in your mortgage, you're buying the mortgage principal down. Every day that the money sits in there, you're paying less. So it like sweeps it on a daily basis. So it's pretty cool. So now back to the program. And I wanted just to say, thank you, Angie, for continuing to sponsor us. She's with JMJ Financial, the Thibodeau Morel Group, and you can reach her at 310-418-9722. Thanks a lot, Angie, for your continued sponsorship. And then once again, let's get back into it and talk about this. Everybody was thinking that with these higher interest rates, and boy, we had interest rates that got all the way up to 8% in 2023. And a lot of people thought, boy, that the wheels are going to come off the housing market and everything's going to implode. And you have to really start to peel back. Okay, where are we with supply and demand? And this is an old economics term with supply and demand, where you have to bring it down to a really simple level. And this is where we figure out, okay, what's going on based upon the amount of supply and then where demand is. And as you know, that once we went into these higher rate environment starting in 2022, this is the 2022 curve for the pending home sales index from National Association of Realtors. And you could see that as the year progressed and rates got higher, that the pending home sales index started to nosedive. It was a waterfall dive and got to levels that we have not really seen since the Great Recession. So demand was really low. And you could see there are actually three hills. There's a third hill on the right-hand side, and that hill is the start of 2025. And so you have 2023, 2024, and 2025 on the right. And you could see how pending sales are muted. And they're muted, and they're very similar to Great Recession levels. But the issue that we have is that we don't have the same amount of inventory that we had during the Great Recession, and that's why values have not really come down. So when a lot of people are saying, well, look at all the inventory we have, let's get into what that means. Because where we were during the Great Recession, if you look over here on the left-hand side, we had 4 million homes as early as 2006. There was 3 million in the fall of 2005, and that's what we're showing on the left-hand side. 2006, 2007, 2008, 4 million. In 2022, that's what the arrow shows right there. You could see that there were less than 1 million homes on the market across the United States. And that was a threshold. It was an all-time low going all the way back to the 80s when the National Association of Realtors started keeping track of where the national total housing inventory was at. So you could see where we're at right now. And where is it going from here? You can see on the right-hand side that is since 2022, and the very right-hand side is 2025 on this. And we can drill down in a minute to show you what that means. But what happened if you have that low supply? You have very, very low supply, and it's matched up against very, very low demand during the Great Recession. We still had values that went up. And on the right-hand side, you could see that this is the Freddie Mac Housing Price Index I showed you before, all the way through the start of 2022, and this is since 2022. So you could actually see that values came down initially in 2022 on the right-hand side, and initially, but then they started to climb again in 2023, came down a little bit towards the end of 2023, then went up in 2024, went down, and then they started out this year up in 2025. So overall, you could see we're reaching these all-time records in values, and we still have this higher mortgage rate environment. The issue has been that we don't have enough inventory for values to really come down, and we do have that low demand that's very similar to Great Recession levels. So, but what's been changing over time, this is the deficit of homes listed for sale. I call this hunkering down. There were a lot of people that did not place their homes on the market. It started in 2022. And in 2023, very few homeowners came on the market at what was typical. This is compared to the average 2017, 18, and 19 on a monthly basis. And so we were missing a lot of houses that normally come on. But you can see what's happening, that in time, what we've had is more and more people, more and more homeowners placing their homes on the market. There are more sellers out there. It's still not to where we were prior to the pandemic, but you could see here that it is getting closer and closer to the numbers of where we're at prior to the pandemic. And as a result, we're accumulating more inventory. I showed you where the pending sales index is almost identical year over year over year. You could see those triplets that I was talking about. And we're seeing it in all markets. 2023, 2024, and 2025 almost look identical. And it's the very end of 2022 when interest rates reached 7% that even October through the end of the year looks identical to the end of 2023, 2024, and it will look like 2025 unless something changes in interest rates. But you can see here, this is showing you the blue line is 2023, and it was very, very flat. Normally this is a curve, but this was very, very flat. In 2024, you could see that there were more homes that were accumulating on the market, and that's because it was matched up against very similar demand, yet more homes were coming on the market. If there were more sellers on the market matched up against the same amount of demand, those extra sellers were accumulating. Somebody was unable to sell their home because we're matched up with the same amount of demand because we've been stuck right at that 7% threshold. So this year, even more homes are coming on than last year, which is far more than 2 years ago, the blue line. And the red line, you could see, is accumulating faster than the last couple of years. And that is the extra homes that are coming on the market are accumulating at a faster rate. And as a result, we're building this inventory that is getting closer and closer to the prior to the pandemic, which was the 3-year average, which you're seeing with the green line. We imagine that we're going to get there across the United States, probably in towards the end of the year, that this will match up with where we were prior to the pandemic. There are already markets across the United States that have reached that threshold. But when we're talking about all of the United States, that's the United States as a whole, it's going to take a little bit longer to get there, but it looks like we will arrive to pre-pandemic levels. And so as a result, we're seeing a difference in supply and demand. If you have demand the same, you keep on throwing more and more supply on that, it starts to tilt a little bit in the favor of buyers. Where it's been slightly, demand has been a little bit higher than where we've had supply. So if you have demand that is higher than supply, then as a result, you're going to get prices that come up. But then as this thing equals out and supply continues to rise, it starts to outweigh the amount of demand, you're going to get some pushback on pricing. And as long as rates remain at the 7% level, it is going to become more and more in favor of the buyers. And that's where we talked about moving into buyer market territory, especially the second half of this year. We're done with the spring market. We're into the summer market. By the time we get to the fall and market and the holidays coming up, if there are extra people that are languishing, they might decide, you know what, I'm going to sell my home for a few $1,000s less than the other comparable sell, and you'll start to see prices erode. So as a result, that hot, booming housing market is behind us. We no longer are going to see acceleration of values, because as long as we remain at 7%. And property prices will start to come down. And I know there's a lot of people out there that are just crossing their fingers, hoping that, gosh, I hope that values will come down quite a bit so I can get in. That's not what the recipe is. That's not what the trends show. I'm here to properly set expectations, yet a lot of people will get upset at me for saying this, that property values are not going to crash. They're just not going to crash. And you could see this if you look at where we are as far as inventory levels, and we're just under 1.5 million homes across the United States. That is far below where we were during in 2006, even as early as the fall of 2005, when there are 3 million homes in the market. We have to have double where we are right now just to get where we were in the fall of 2005, and need to get to 4 million homes, which is 2.5 million more homes than where we are right now today. So there's just not enough inventory, and not enough people that are upside down in their homes where they have no equity in their homes. Those people that are underwater, there are very few people across the United States that are underwater. It's like 0.2% versus 5% that were there in 2006, prior to even the beginning of the Great Recession. So we just don't have the number of homes on the market to feed major drops in prices, and we don't have people in sticky situations. So as a result of not being in sticky situations, pricing is going to be extremely sticky. And there's like I told you, the second half of the year, there will be some people who go, yeah, I want to move. And so they might come down a few $1,000s below the last comparable sell. But take, for example, the $500,000 property. If you come off 1%, you're going to sell for $495,000. That's not what people are thinking about when they're thinking housing crash. And that's about the kind of pushback you're going to get in pricing for the second half of the year, maybe down 1% total for the rest of the year. That's not anything major to write home about, but it is lining up more in favor of the buyers, so that there are more options out there, and there are more homeowners, sellers that are going to be willing to negotiate a bit. But they're just not going to give away the farm. No one's going to give away their hard-earned equity. That's how they look at it. Nobody wants to give away equity. Banks, when they were doing foreclosures and short sales, and they were a majority of all transactions during the Great Recession for a variety of reasons which don't exist today, they have no emotion, and they had to sell. So when they have to sell, that's where you got a lot of erosion in pricing. And the overall strength of the housing market. I show this over and over again, and this is why it's a housing. The housing stock across the United States is built with strong credit, great jobs, low fixed payments, record tappable equity, record people that are equity rich, which means they have 50% plus equity in their houses, and record numbers that own their homes free and clear, 40% across the United States. So prices are going to come down, but they're just not going to come down as much as what people think across the United States. There will be some markets, and I know Northeast is probably one of the strongest, right up in the right around Wisconsin and Michigan and that area. There's just not a lot of homes that are on the market, so there still could be some prices that will continue to elevate. But if you're along the Southwest, or if you're in Florida, and you hear a lot of people talk about Florida and Texas as an example, or Tennessee, yeah, those are examples of where they have a lot more inventory, and they do have values that are coming down at a little bit faster of a clip, but nowhere do we have values that are just absolutely crashing. I've seen examples of there are some markets that are where they show that values have come down like 9%, but they're in tiny little communities of about where there's like 25,000 people that live in those in a small community. They use that as an example as ground zero of what's going to happen across the United States, but the metrics just are not there. So go to reportsonhousing.com for more information. We have a variety of housing reports that dot all over SoCal, the Bay Area, Phoenix, and also Las Vegas. And the most recent report that came out is called The Speed Factor. And if you'd like a free month, when you subscribe, utilize the coupon code BOOM, because the housing boom is over. So thank you for joining us for another housing debrief. I really appreciate it. I hope you like the content. Once again, like and subscribe to our channel. We'd really appreciate it. And I hope you have a fantastic weekend, and we will see you on the other side.